March 15, 2025. The Federal Reserve made a policy announcement that only happens once every 2 decades. A pivot so extreme, so sudden, that within 72 hours $3.4 trillion in institutional capital started repositioning. Not thinking about it, not considering it, actively moving right now as I'm recording this. And if you think this doesn't affect your mortgage, your retirement account, your job security, I need you to listen very carefully to what I'm about to tell you. Because while you were watching TikTok and scrolling Instagram, the largest financial institutions in the world started doing something they only do when they see catastrophic risk coming. They're rotating out of positions they've held for years, systematically, quietly, without press releases or announcements. This isn't speculation. This is documented in SEC filings, in Treasury reports, in central bank data. You can verify yourself right now. The policy pivot I'm talking about, this specific type of reversal from one monetary extreme to another, has triggered market chaos for times in the last 90 years. Not similar chaos, identical patterns, same warning signs appearing in the exact same sequence, same institutional behavior, same timeline from pivot to collapse, and most importantly, same devastating outcome for everyone who didn't see it coming. By the end of this video, you'll understand exactly what this trapdoor mechanism is, why central banks create it every single time without fail, and most critically, where we are in the cycle right now today. Because there's a 3-phase pattern here, a mathematical sequence that's played out for times since 1929. Same phases, same duration, same result. History doesn't repeat, but it rhymes perfectly when central banks are involved. And right now, in real time, we're watching the rhyme structure complete itself again. The only question is whether you'll recognize the pattern before phase 3 hits, or whether you'll be asking like millions before you, how did I miss every single warning sign when they were right there in front of me the entire time? Stick with me, because the next 20 minutes will change how you think about central bank policy forever. And more importantly, it might just save your financial future. Right now, today, we have the Federal Reserve holding rates at restrictive levels, while simultaneously signaling potential cuts. The European Central Bank cutting while inflation persists. The Bank of Japan finally raising rates after decades at zero while their currency collapses. And the People's Bank of China easing while their property sector implodes. These aren't coordinated policies. This is monetary chaos disguised as strategy. Here's what nobody's telling you. Central banks operate in extremes. They push policy to one direction until something breaks. Then they panic and reverse to the opposite extreme. That reversal, that sudden pivot from too tight to too loose or too loose to too tight, that's the trapdoor. And it opens fast. The numbers tell the story. The Federal Reserve took interest rates from 0.25% in March 2022 to 5.5% by July 2023. That's a 5.25% increase in 16 months, the fastest tightening cycle in for decades. Their balance sheet went from $9 trillion to under $7.5 trillion. $1.5 trillion in quantitative tightening while the economy was still digesting $5 trillion in COVID stimulus. Now they're talking about cutting, pivoting again, from maximum restriction to accommodation, from draining liquidity to potentially adding it back. This whiplash, this extreme policy reversal, this is the trapdoor opening. And it's happened before, for times in the last 90 years. Every single time, the pattern was identical. Let me show you the 3-phase cycle so you can recognize exactly where we are right now. Phase 1. Extreme policy in one direction, either too loose for too long, inflating massive bubbles, or too tight for too long, choking off credit and growth. Duration typically 3 to 7 years. Everyone adapts to the extreme. Markets price it in. Confidence builds that it's the new normal. Phase 2, the pivot. Central banks realize they've gone too far. They reverse course suddenly. Rates that were rising start falling, or rates that were falling start spiking. The reversal happens faster than anyone expects. Markets that were adapted to the old regime suddenly face a new reality. This phase lasts 6 to 18 months. Phase 3, chaos. The system breaks. Something big fails. Banks, markets, entire sectors that were built for the old policy environment can't survive the new one. Panic spreads. Contagion accelerates. The pivot that was supposed to fix everything actually triggers the collapse. Duration 12 to 36 months, 3 phases. Documented. Repeatable. Mathematical. Let me prove it. 1920s America. The Federal Reserve had only existed since 1913. Still figuring out how to manage the economy. Still learning by trial and catastrophic error. And what they did was keep rates low throughout most of the decade. Money was cheap. Credit was abundant. Anyone could borrow to buy stocks. Margin lending exploded from $1 billion in 1920 to over $8.5 billion by 1929. People borrowing 90% to buy equities, paying just 10% down. the market went vertical. The Dow Jones rose from 63 in August 1921 to 381 by September 1929. A six-fold increase in 8 years. Everyone was getting rich. Taxi drivers giving stock tips. Shoeshine boys talking about their portfolios. The new era of permanent prosperity. Phase 1 complete. Then the Fed saw inflation creeping in. Asset prices detaching from any economic reality. And they got nervous. August 1928, they started raising the discount rate. From 3.5% to 6% by August 1929, they tightened credit conditions. Margin requirements increased. The pivot happened. Not gradually, aggressively. The smart money saw it immediately. Major banking families started liquidating positions in early 1929. Joseph Kennedy famously exited the market completely after his shoeshine boy gave him stock tips. The Rothschild family reduced American equity exposure significantly, but the public kept buying. The headlines still screamed new highs. Nobody believed the party could end. Phase 2 documented. October 1929. The Trapdoor opened. Black Thursday, October 24th. The market dropped 11%. Black Tuesday, October 29th. Down another 12%. $30 billion in market value evaporated in 2 days. That's nearly $500 billion in today's money. But that wasn't the chaos. That was just the beginning. The chaos was what came next. Over 9,000 banks failed between 1930 and 1933. 9,000. People's life savings disappeared overnight. No FDIC insurance. You picked the wrong bank. You lost everything. Unemployment hit 25%. 1 in 4 Americans couldn't find work. The economy contracted 30%. Deflation spiral. Prices falling. Debt burdens increasing. Foreclosures everywhere. Breadlines in every city. The pivot from easy money to tight money didn't prevent the crash. It triggered it. It guaranteed it. Phase 3 complete. Same 3 phases. Same sequence. Same devastation. 1970s America looked stable on the surface, but underneath, the monetary system was rotting. Inflation wasn't a headline. It was a lifestyle. In 1971, Nixon broke the dollar's last link to gold, and by the middle of the decade the numbers were screaming. CPI inflation surged into the double digits, energy prices exploded, wages chased prices, and prices outran wages again. The Federal Reserve tried to manage it gently, like you can tap the brakes on a runaway truck and expect it to stop. They kept rates too low for too long, and the public adapted to permanent inflation. People didn't save. They spent fast before prices went higher. Real assets outperformed paper assets. Gold went from $35 an ounce to hundreds. Real estate became a speculation machine. Phase 1 wasn't a boom in stocks like the 1920s. It was a boom in debasement. And everyone pretended it was normal. Then August 1979. Paul Volcker walks into the Fed and basically declares war on inflation. And here's the part most people still don't understand. The trapdoor wasn't the high inflation. The trapdoor was the pivot. Because the moment a central bank goes from tolerance to zero tolerance, from we'll manage this to we'll crush this, the entire credit system has to reprice overnight. The Fed pushed the federal funds rate up into the high teens. Not over years, over months. Businesses that could refinance at 8% suddenly faced 18%. Homebuyers went from affordable mortgages to impossible ones. The cost of capital didn't rise. It teleported. Credit markets froze because nobody knew what anything was worth anymore. Banks pulled back. Lending standards tightened. Liquidity vanished. Phase 2 complete. Then phase 3 hit, and it hit exactly where it always hits: leverage. Housing. Weak banks. Overextended companies. The economy slammed into recession. Unemployment surged above 10%. Entire sectors collapsed because they were built on cheap debt that no longer existed. Farmers lost land. Builders stopped building. Small businesses died first, then bigger ones. And the cruel irony is this: the pivot worked. Inflation eventually fell. But the cost was chaos, because the trapdoor always fixes the problem by breaking everything. That depended on the old regime. Same 3 phases. Same sequence. Same lesson. The late 1990s felt like a new religion, and the god was the internet. Money was easy, optimism was infinite, and valuations stopped meaning anything. The Federal Reserve held rates low enough, long enough. That capital didn't just flow into technology, it stampeded. Companies with no profits, sometimes no revenue, went public and doubled on day one. CNBC became background noise in every office. Day trading wasn't a hobby, it was a career plan. The Nasdaq climbed like gravity had been turned off, rising from under 1,000 in 1995 to over 5,000 by March of 2000. People didn't ask what a business was worth. They asked what it could be worth if the story kept going. Phase 1 complete. Then the Fed started doing what central banks always do at the worst possible moment. They pivoted, not because the bubble was obvious to the public, but because inflation pressure and overheating were showing up in the data, and because markets had become too dependent on cheap credit. 1999 into 2000, rates rose in a series of moves that didn't sound dramatic in isolation, but were lethal in combination because the entire tech boom was built on the assumption that money would stay cheap forever. That's how the trapdoor works. You don't need a massive change. You need a change that breaks the model everyone is using, and smart money noticed. Not the public. Not the analysts on television still upgrading unprofitable companies to strong buy insiders. Executives, venture funds, institutions that understood one thing: when the cost of capital rises, the future gets discounted harder, and tech stocks are almost entirely future. Their value is a promise. Raise rates, and you don't just lower the promise, you crush it. Phase 2 documented. Then phase 3 hit like a controlled demolition. The Nasdaq didn't drift down. It collapsed, eventually losing roughly 78% from peak to trough. Trillions evaporated. Icons disappeared. Pets.com became a punchline. IPOs froze. Layoffs spread from Silicon Valley to everywhere that had believed the hype. And what looked like a tech problem turned into a credit problem, then a confidence problem, then an economy problem. The pivot didn't pop the bubble gently. It detonated it. Same 3 phases. Same sequence. Same lesson. When a market is priced for one policy regime, the pivot is the match. 2002 to 2006. America ran the most dangerous experiment in modern finance, and most people didn't even realize they were participating. After the dot-com crash and 9/11s, the Federal Reserve pushed rates down to emergency levels and kept them there long enough for an entire generation of borrowers to believe cheap money was permanent. Mortgages became marketing products. Lending standards didn't loosen, they collapsed. Adjustable rate loans, no-doc loans, zero-down loans, teaser rates designed to explode later. Housing prices didn't rise because fundamentals improved. They rose because credit became infinite. Wall Street took that debt, sliced it into mortgage-backed securities, repackaged it into CDOs, stamped it AAA, and sold it to pensions and banks around the world as if it was government-grade safe. Phase 1 complete. Then the Fed did what central banks always do when they realize they've created a monster. They pivoted. Rates didn't creep up. They marched up, step after step, until the federal funds rate was over 5%. And here's the trapdoor. Housing doesn't collapse when prices stop rising. Housing collapses when refinancing stops working, when the monthly payment resets, when the buyer disappears, when the math breaks. 2006, housing peaked. 2007, the cracks spread. Delinquencies rose. Foreclosures climbed. But the public still believed it was contained. They always do. Meanwhile, the smart money was already positioned. Credit default swaps quietly pricing in disaster. A few investors looked at the actual loans inside the securities and realized the entire system was built on fraud-grade underwriting and fantasy assumptions. They didn't scream on television. They didn't beg for attention. They just placed their bets and waited. Phase 2 documented. Then phase 3 arrived, and it arrived exactly where it always arrives. Leverage. Banks. Confidence. Bear Stearns first, then Lehman. Money markets breaking the buck. Interbank lending freezing because nobody trusted anyone's balance sheet. The S&P 500 eventually down more than 50%. Global trade seizing up. Bailouts, emergency facilities, backstops for backstops. And the part that matters for you is this: the pivot didn't prevent the crisis. The pivot triggered the chain reaction that revealed how fragile the entire structure was. Same 3 phases. Same sequence. Same lesson. When policy flips, the hidden leverage dies first. Then everything built on it follows. The world shuts down. And central banks hit the panic button so hard they almost snap it off the wall. Rates go to zero. Money printing goes exponential. Balance sheets expand like there are no consequences because, in the moment, everyone is terrified and nobody wants to be the person who didn't do enough. And for a while, it works. Markets don't just recover, they levitate. Stocks surge. Housing explodes. Crypto goes from a niche to a mania. Anything with a ticker becomes an asset. Anything without one becomes dead money. Phase 1 complete. Then 2020 arrives and inflation shows up like a bill you can't refinance. Suddenly it's not academic. It's your groceries, your rent, your insurance, your energy. And the Fed pivots. Fast. The fastest tightening cycle in modern history. That's not drama. That's just the reality of going from emergency mode to restriction mode in a system that was built on free money. Because when you train markets for a decade that rates will always be low, and then you yank the floor out, you don't create a soft landing. You create stress fractures everywhere. And here's the trapdoor people miss. It's not just the hiking. It's the whiplash. Tighten hard enough and something breaks. then you're forced to talk about cutting again, or pausing, or data dependence, and now nobody knows what the rules are. Businesses can't plan, banks can't price risk, investors can't value cash flows. The entire transmission mechanism turns into noise. Phase 2 is confusion disguised as control. You've already seen the early casualties. Regional banks that looked fine until their bond portfolios got repriced by higher rates. And suddenly safe assets became lethal. Commercial real estate under pressure because cheap refinancing is gone. Consumers leaning on credit cards because wages didn't keep up. Corporations sitting on mountains of debt that has to roll over at higher rates, higher spreads. Worst terms. This is what phase 3 looks like right before it becomes obvious. The headlines still debate whether the economy is strong. The market still rallies on the idea of cuts. But underneath, liquidity is thinning, defaults start rising, and the smart money stops chasing upside and starts positioning for survival. Because the pivot isn't the solution. The pivot is the trapdoor. And once it opens, the chaos doesn't ask for permission. It just spreads. I know what you're thinking. If central banks see this pattern, if they have armies of PhDs and models and stress tests and emergency tools, why would they let the trapdoor open again? Why would they repeat the same mistake for the 5th time? Because they don't think they're repeating it. They think they're managing it. And central bankers always believe the next pivot will be the one that lands perfectly. They said it in 1929. They said it in the 1970s. They said it in 2000. They said it in 2008. And they said it again in 2021 when they told you inflation was transitory. That single word should have ended the debate for anyone paying attention, because it proved they were behind the curve, not ahead of it. You might also be thinking, the economy looks fine. Unemployment is low. Companies are still hiring. The stock market keeps bouncing back. Surely that means we're safe. But that's exactly how phase 2 feels right before phase 3 becomes undeniable. In 1929, unemployment was low until it wasn't. In 2007, credit was flowing until it froze overnight. The system doesn't collapse when the public is already afraid. It collapses when the public is still confident and leverage is still hidden. And the biggest objection of all is the most dangerous one. They'll just pivot back to easy money and save everything. They'll cut rates, restart QE, support the banks, backstop the markets. That's the point. The pivot is the trigger. When you tighten hard enough to crack the plumbing, and then loosen fast enough to fix it, you don't restore stability. You destroy trust in the rules. Investors start realizing policy is reaction, not strategy. Inflation expectations union call. Currency confidence weakens. Capital stops behaving like it's in a normal cycle and starts behaving like it's in an exit. Central banks don't control outcomes. They control the timing of the break. And once the pivot happens, the break is just a matter of which piece fails first. So what does this mean for you practically, starting today, not next month? Not when the headlines finally admit what's happening today? First, you need liquidity. Not because cash is some magical safe asset. It's not. Inflation eats it. But liquidity is optionality, and in phase 3, optionality is survival. When markets gap down and credit tightens overnight, the people who can move quickly are the ones who buy assets from forced sellers. The people who can't move get trapped inside positions they can't exit, at prices they can't accept, on timelines they don't control. Second, reduce leverage now before you're forced to. The trapdoor doesn't punish optimism, it punishes debt. It punishes anyone who needs refinancing to stay alive. If you're carrying high-interest consumer debt, variable rate loans, or you're overextended on a mortgage payment that only works if everything stays stable, you're playing chicken with the exact mechanism that has wrecked people in every phase 3 we've ever studied. Third, stop pretending diversification means owning 10 versions of the same risk. If all your wealth is tied to the same liquidity cycle, the same central bank, the same currency, you're not diversified, you're concentrated. In every historical chaos phase, the crowd is always overweight the assets that performed best during phase 1. That's the trap. That's how the transfer happens. Fourth, shorten your time horizon on safe assumptions. Long-duration bets are fragile when policy is unstable. The further out your payoff depends on a perfect future, the more a pivot destroys your math. In chaotic regimes, durability beats brilliance. Cash flow beats promises. Fifth, build resilience outside the market. Skills, relationships, health, adaptability. Because when the trapdoor opens, the winners aren't always the smartest investors. They're the people who can keep earning, keep moving, keep thinking clearly while everyone else is panicking. You don't need to predict the exact day. You need to respect the phase. And right now, the phase is telling you one thing: prepare like the rules are about to change. Because they are. And here's the part most people won't understand until after it happens. The trapdoor doesn't announce itself. It doesn't ring a bell. It doesn't wait for a headline that says, market chaos begins tomorrow. It opens on an ordinary day, in the middle of an ordinary week, while most people are still arguing about whether the pivot is bullish or bearish, because that's how this always ends. Phase 1 builds the illusion, Phase 2 builds the confusion, and Phase 3 delivers the consequences. You've now seen the pattern across a century of modern markets. Easy money creates fragility. Tight money exposes it. The pivot detonates it. And once the system realizes policy is reaction instead of control, confidence becomes the only thing holding it together. When confidence cracks, liquidity disappears. When liquidity disappears, prices don't fall gently. They gap. They cascade. They force selling. They create contagion. And the smart money understands something the public doesn't. Central banks don't prevent chaos. They choose the shape of it. They can delay it, redirect it, disguise it, but they can't erase it. Not when the entire financial system has been trained to depend on cheap capital and constant intervention. So if you take one thing from this video, let it be this. Stop asking whether the pivot is coming. The pivot is already here. The real question is what breaks first as the trapdoor opens wider. If you're prepared, this period can be an opportunity. Not the kind of opportunity influencers sell you, not overnight riches, but the real opportunity that comes when weak hands are forced out and strong hands with liquidity can buy quality assets at prices that don't exist in normal times. But if you're unprepared, this is how people lose decades of savings in months. How they wake up and realize their safe portfolio was just a leveraged bet on stability. Drop a comment and tell me what you think the first domino is. Is it commercial real estate, consumer credit, sovereign debt, or something nobody is watching yet? I read every comment. And subscribe, because in the next video I'm going to show you the 3 specific areas that historically hold up best when the trapdoor opens, and the 2 that look safe right now but get obliterated in Phase 3. The pattern is clear. The pivot is the trigger. The only question is whether you'll act before the crowd realizes the floor is already gone. Thanks for watching. And remember, the people who make it through these transitions aren't always the ones with the most money. They're the ones who see the trapdoor and move before it drops.